Hey, what's up you guys, it's Kurt here. Today I want to do a question which came from one of my subscribers, which is, should we invest in our company stock? So if you work for the company and they give you things like RSUs or ESPP, what should you do? Is that actually a good option to invest? And I want to answer this not only for just this subscriber, but for everybody else. So I thought, let me make a quick video about it and perhaps everybody else can benefit. Investing in the company stocks can be done in multiple ways, but I want to go first over the 2 or 3 most common ways that people usually invest in company stocks. And then that will serve as a baseline for us to do 4 considerations of how we go about the decision whether we should invest in company stock and to what extent. And before we continue, if you're new here, make sure to subscribe because we do a lot of videos on investing, personal finance, and financial independence. So you don't want to miss that content, and make sure to also hit the bell notification icon so you're notified every time I post a video just like this one. So as we consider investing in the company stock, let's take a look at what are the most common ways to invest in the company stock. So stock options, which are part of your compensation package as you start to work for a company, those are a very common way, especially for startups, to attract people and to give them some equity or some portion of the company as an incentive. But in order for you to exercise the options and then to have financial benefit to you, your company needs to either go IPO, go public, or it needs to be acquired by another company. So unless that happens, your stock options pretty much are useless. A second common way to own company stock is through RSUs, or those are restricted stock units, which usually vest with time and usually takes about a year or longer for those units to vest, which is at that point when you actually own shares of the company. Before that point, your RSUs are kind of worthless because you really can't do much with them. You can't really cash them in, you can't sell them because they haven't vested yet. And the third option to own your company stock, which is also very common, is to buy company stocks through ESPP plans or employee stock purchase plans. Those are usually plans which allow employees to purchase stocks oftentimes at a discount from the market price. And usually ESPP plans may offer things like 5% discount or 10% discount or even 15% discount of the stock market price of the shares of your company. So with that said, let's go over 4 considerations that you should take into account as you're considering investing in your company stock. So consideration number 1, consider the risk of owning your company stock. And that risk may be huge, especially if that's the only investment that you have. If you only invest in a company stock, that's generally considered a bad decision because anything can happen with the company. So your company may do well a few years from now and you can benefit from the stock, but it could be exactly the opposite scenario as well. The company can do very poorly and you can lose all of the value that you put into the company shares. Now, if you only had restricted stock units, RSUs, and you didn't really put any money into it, but you're hoping for some equity down the road when those RSUs vest, that could also be not the case because you may actually not have any value once those RSUs vest because, again, the company has done poorly. And the reality is there is nobody that can tell you that. Nobody knows how your company is going to do. You're not at the level of the executives which make some of the board decisions, and you have no idea how the company will do or how it will be positioned in the market because it's beyond your control. So in that case, what I would suggest is that consider the risk and consider diversifying away from that risk. And the most common way is to have other investments or to invest in other stocks beyond your company. Consideration number 2, putting your eggs all in one basket, and that's a biggie. I want to stress the fact that when you buy company shares, you're investing a lot more than just those shares because, first of all, you work for the company, so your salary is dependent on how well the company does. If the company does well, also likelihood is your salary will grow, you'll have higher bonuses, so you will do well. And your stocks will do well, most likely. But if the company does not do well, your salary will not grow, you will not get any bonuses, and chances are the stock prices will go down. So you're losing on both fronts. on salary and on your stock investments. Furthermore, a lot of people also have the opportunity to invest in 401k plans through the company, and often people are encouraged to own their company stocks within the 401k. This is also bad because you're not only locked in with your salary, not only with the shares that you're investing, but even within your 401k where you have the opportunity to buy stocks, let's say for other companies, and you have the opportunity to get the company match, you actually still, that opportunity to own equity is still wasted away, so to speak, on your company. Also, if you don't live in a huge city, for example, you live in a smaller town and your company is a big employer in this town, consider this: the real estate value is also tied to the success of your company. And again, if your company moves their headquarters or moves their office somewhere else in another city, then chances are real estate prices of your area may drop significantly. So if you own real estate and you work for this company, your real estate, the value of a house, is dependent on how well your company does in your town. So all of these things combined are actually to be considered as you answer the question, should you own company stock? Consideration number 3, consider the fact that oftentimes companies are not able to sustain their success. Oftentimes the company shares will go up and down, and in the long run they may not actually make you money specifically. Obviously there's people that got rich, some people got rich overnight, but that may not be the case for you. And the reason why I say that is because there's many examples in history where big companies, successful companies, were not able to deliver on the promise. And they offered not only company shares as a good investment for your future, but they offered like pension plans and all sorts of incentives, which in the end did not pan out. And a common example is IBM, which back in the days was very successful. It was the company to own, and in fact they went out in public saying that there will never be layoffs at IBM. They also said that IBM is a sure winner, so owning IBM stock is the best thing you can do with your money. But what happens is, a few years down the road, the company stock's value pretty much halved in value. And the reason why I'm giving IBM is because it's one of the tech giants in the past, and it's a story where it's worth mentioning because a lot of the value in today's companies is centered around the FANG stocks. So Facebook, Google, Netflix, Amazon, those are all tech companies, and that may not continue in the future, just like what happened with IBM. But there's other examples as well. There's GE, there's Kodak, there's Xerox, there's Enron is the biggest example, obviously. So all of those companies were very successful in the past. A lot of people invested in those companies as a single biggest investment they did, and they lost a lot of value. So consider learning from history as you make the decision whether you should invest in your company stock or not. Consideration number 4, if you work for any of the tech giants, the big companies, the FANG stocks as they call them, Facebook, Apple, Amazon, Google, Netflix, those are all good companies, and chances are you will do well in general. You will do well with your salary and bonuses, with your compensation, and then if you have some stocks, most likely they will grow in value and you will do well. However, what I want to highlight is, in consideration number 4, don't forget consideration number 1, 2, and 3. Don't bet on a single company. Don't bet all your money in one basket. And don't forget history, because history has shown us that even the biggest giants, they've done poorly as you consider what happens in the long run. All right, and the last bit of information I want to share with you is some best practices and principles that you can follow. So number 1 is, you don't want to be investing more than 10% of your net worth in your company stocks. So if you get RSUs and you can purchase things through ESPP plan, again, if it's more than 10% of your savings or your investment portfolio, consider selling those so you're keeping it down less than 10% even. My second rule is, have a strategy to sell your company shares. So say you have RSU units which are vesting once a year, have a strategy to sell those shares immediately after they vest, for example. Or if you have an ESPP plan and you're buying shares at a discount rate of, let's say, 10% discount or 15% discount from the market price, have a strategy to sell those either immediately after you buy them or as soon as your ESPP plan allows. Rule number 3 is diversify, diversify, diversify. I can't stress enough that you need to be playing defense with your investments in general. So buying your company stock only, especially if that's your only investment, that's not a good move. You want to be diversifying away your investments by buying other funds and other shares of other companies. So my suggestion is to buy broadly diversified index funds, whether that's mutual funds or ETFs, it doesn't really matter. But chances are, the odds are that you'll do better than just buying your own company. By the time you find out that those shares that you bought with the company are not going to do well, it's going to be too late. And I really like to share a quote that I love from Warren Buffett here, which reads, "Only when the tide goes out do you discover who's been swimming naked." All right, I'll leave you with that quote. Think about it long and hard whether you should be investing in your company stock and to what extent. Now, if I helped you with this video, if you liked the video, don't forget to hit the like button because that helps with the YouTube algorithm. If you've got any questions or comments, put them down in the comment section. If you're new to the channel, don't forget to subscribe because we do a lot of videos on investing, personal finance, and financial independence. Until next time, I'll talk to you later.